Hi there. In this video, we're going to walk through the two different methods of accounting, one being cash accounting, the other being accrual accounting. We're going to walk through an example showing the differences between the two by creating an income statement. So let's get started. Hi, today we're going to talk through an example where we work through the cash method of accounting versus the accrual method of accounting. A cash method of accounting just means that we won't recognize any transaction unless it actually has cash exchanging hands. Think of this as your checkbook. And so if you had a small business or something like that and you've got your checking account that's associated with it, if you get cash or you use cash, that's the only time that you would actually recognize a transaction. In the accrual method, however, this means that with few exceptions, you're going to recognize financial transactions even if no cash actually exchanges hands. If you are not a publicly traded company, then you have a choice as to which method you will use. So if you're a small business, you can choose to go with the cash method and just do your accounting out of your checkbook. However, if you are a publicly traded company, then you have to use the accrual method. There is no choice for you. And the reason for that is when we want to do ratio analysis or compare company to company in an industry, for example, we want each company to be using the same methodology. So they have to use the accrual method so that we can compare apples to apples. So let's work through an example here. And if you want to go to my website, if you look down below in the description, you can go and download a copy of this as a blank template where you can follow along with this and you can practice on your own. So in this example, we have sold some products for $20,000. We've received some cash as a down payment, and the rest the customer will pay later. And the cost to produce these products was $7,000. So from a cash method, we have to look at this as, did we actually receive or use any cash? And the only cash that has actually exchanged hands here is the $12,000 down payment. So we would recognize that under the revenue. Now, we're being asked to do an income statement. We're looking at this just from that perspective. So we're only looking at this from the standpoint of, did we get any revenue and did we pay any expenses? Anything else that has to do with the balance sheet, we would ignore. So from an accrual method, we had a sale of $20,000 and we have to recognize that sale even if we don't receive any money for it yet. So we'll have a sale of $20,000. Associated with that, you have a cost of goods sold or a cost to produce those sales, which was $7,000. So we recognize that expense. The $12,000 cash that you received in the accrual method, we would ignore that in building an income statement because cash is actually a balance sheet account. The amount that's to be paid on account for next month, that's going to go into accounts receivable, which is also on the balance sheet. So we would not put that on here as for the income statement. The next thing we've done is we've purchased some more inventory. We paid $2,000 cash and we owe the rest on account. In the cash method, the only cash that is exchanged hands is the $2,000. So we will represent that under the expenses for $2,000. On the accrual method, none of this is actually hitting the income statement because when we buy inventory, the inventory is going to go into an asset account that's on the balance sheet. And we've spent some cash, but cash also is on the balance sheet. And we have an accounts payable because on account from this perspective means that we're using accounts payable, but that is a liability and liabilities are on the balance sheet. So we do nothing on the accrual method. Next, we've paid $1,500 in wages. So we've actually spent this money. So from a cash perspective, we have to recognize it because we actually wrote a check to those individuals, however many there are. And on the other side, from an accrual method, we have that expense that we've actually incurred, so we have to recognize wages expense. Next, we received a $1,000 invoice for advertising to be paid next month. So from a cash perspective, we haven't spent anything. We're not going to spend it until next month. So we don't recognize any cash exchange at all. From an accrual method, though, we've received that bill. We have to recognize that expense, even though we're going to pay it later. So that actually is an accounts payable that we're going to set up where we will pay it later. But the advertising expense, we have to recognize it now. And finally, we have received deposits of $2,500 from customers for orders that will be delivered next month. So we have received cash. Therefore, from a cash method, we have to recognize that because we actually got the cash. So we have our deposits of $2,500. On the other side, from an accrual method, we've received that $2,500. It went into cash, but cash in an accrual method is going to sit on the balance sheet. So therefore, we don't recognize it on the income statement until we actually deliver those goods. And that will be something that later on, as we get the cash, we'll deal with that. But it's not even recognized right now as a revenue at all because we actually have not delivered the product to the customer. So from a net income perspective, you can see that these two methods actually come up with different net incomes. So on our cash method of accounting, we have a net income of $11,000. And from a net income perspective on the accrual method, we have a net income of $10,500. That's why we want to make sure that when we're talking about publicly traded companies that they all use the accrual method so that we know that they are arriving at their net income numbers in a similar way. So finally, let's recap. You have no choice as far as which method if you are a publicly traded company. Your choice in whether you use cash or accrual accounting, if you have the choice, affects the net income that you report. And accrual-based accounting shows the most accurate financial position of your company. With that, please leave comments. Please let me know if these are working for you. Please let me know if you're learning from these and if I need to make any changes to these videos. And we will be on to another subject shortly. Thank you.